You are standing at the pump on a Tuesday. The number is climbing past where it used to stop. You do not say anything. You watch it hit $62 and pull the nozzle out. 6 months ago, that fill-up was $45. You have not driven more. The car has not changed. You have a vague sense that something is off, but there is a line behind you and you have somewhere to be. So you get in and drive. That $17 difference is not random. It is not seasonal. It is not going away. It traces back to a specific waterway, 21 miles wide at its narrowest point on the other side of the planet, and it is connected to your grocery receipt, your mortgage rate, and something that happened in your Amazon account last week that you probably did not notice. This video traces the whole chain. Welcome to Arthur Logic. Finance, investing, wealth building, and money psychology. Explained simply and honestly for people who are done being confused about money. If you want to understand not just what is happening to prices right now, but why it is happening and what comes next, subscribe. Because this story is not finished and neither is the damage, 21 miles. At its narrowest point, the Strait of Hormuz is 21 miles wide. That is roughly the distance from Times Square to JFK Airport in New York City, a gap you could drive in under 30 minutes on a clear day. 4 of March 4, 2026, roughly 130 ships moved through that gap every single day. Tankers carrying crude oil, vessels carrying liquefied natural gas, container ships carrying fertilizer, aluminum, chemicals. According to the International Energy Agency, approximately 20% of the world's crude oil and a similar share of global LNG shipments flowed through that corridor daily. 1 in every 5 barrels of oil on the planet passed through a waterway narrower than the width of a mid-sized American city. On March 4, 2026, that stopped. Not to UNCTAD, ship transits through the strait collapsed from approximately 130 per day in February to just 6 in March, a reduction of roughly 95%. The IEA characterized what followed as the largest oil supply disruption in the recorded history of the global oil market. Not one of the largest, the largest. Between 2 and 3 times the scale of the 1973 oil shock that caused gas rationing lines across the United States that crashed the economy, that people still reference 50 years later as the moment they understood how fragile the energy system was. The 2026 disruption removed more than twice as much supply from global markets as that event did. And most people heard about it between 2 other headlines and assumed it was happening somewhere else, to someone else's money. The first place it arrived was the gas pump. Brent crude surged from roughly $70 per barrel before the conflict began on February 28th to near $120 per barrel at peak, a move of more than 70% in under 30 days. According to the American Automobile Association, the U.S. national average gasoline price crossed $4 per gallon by the end of March 2026, the first time that threshold had been crossed since August 2022. California went above $5. The average American drives approximately 100 miles per month in a car averaging around 28 miles per gallon. That is roughly 39 gallons per month. At 0.4 per gallon, that is $160. At the pre-war price of approximately 3 cents, it was $121. The Strait of Hormuz closure is costing the average driver roughly $39 extra per month at the pump every month for as long as this persists. That is $468 per year before any other category of the household budget is touched. And the pump is the most visible cost. It is not the largest one. The second place the damage arrived was quieter. According to the U.S. Bureau of Labor Statistics, the Consumer Price Index jumped from 2.4% in February 2026 to 3% in March, the first CPI report released after the conflict began, and the single largest one-month move in the inflation figure in 3 years. That jump was driven primarily by energy prices feeding through every product that requires fuel to produce, process, or move. Shipping carriers felt it first. UPS and FedEx both imposed higher fuel surcharges since February. On April 17, 2026, Amazon added a 3.5% fuel and logistics surcharge for third-party sellers in the U.S. and Canada. That surcharge does not appear on the checkout screen labeled Strait of Hormuz fee. It shows up in the item price. A household spending $800 per month on groceries facing 3.3% CPI inflation driven by energy costs is paying roughly $26 more per month on food alone. Combined with the pump, The average household is already absorbing approximately extra per month from the first wave of this disruption. The next time a package costs slightly more than you expected, it will not explain itself. It will just cost more. Consider for a moment the American farmer standing in a field in mid-March 2026, preparing to plant corn. The Strait of Hormuz carries roughly one-third of internationally traded fertilizer. Natural gas, which determines between 70% and 90% of the cost of producing nitrogen fertilizer, saw production drop 20% due to the war, with price increases of up to 70% reported by Fortune. In the U.S., some fertilizers rose more than 40% in a single month after the war began. By mid-March 2026, the U.S. fertilizer supply was sitting at approximately 75% of normal levels, and mid-March is precisely when Corn Belt farmers begin their first applications, with subsequent rounds running through May and June. Farmers facing a fertilizer shortage at planting time make one of three choices. They reduce the amount of fertilizer applied, which lowers yield. They switch to a less fertilizer-intensive crop like soybeans, or they plant less land. Any of those three outcomes reduces the 2026 corn supply. USDA research shows that retail food prices follow farm-level price changes by 2 to 4 months. The fertilizer disruption happened in March. The grocery shelf reflects it in June, July, and August. The price increases you have already noticed at the supermarket are not the full story. They are the first chapter of a story whose later chapters are still in transit. The oil shock from the Strait of Hormuz is not confined to gas stations and grocery stores. It moved into the bond market and through the bond market into the monthly payment of every person with a mortgage, a car loan, or a plan to buy a home. By March 27, 2026, the 10-year U.S. Treasury yield had spiked to 4.46%, its highest level since July 2025. By March 26, the 30-year U.S. mortgage rate had climbed to 6.38%. The mechanism is direct. Oil shocks create inflation expectations. Inflation expectations move bond yields. Bond yields rates. Goldman Sachs raised their 2026 U.S. inflation forecast by 0.8 percentage points to 2.9% in their moderate scenario. In an extreme scenario, a full month of disrupted oil flows with crude averaging $110 through March and April. They projected inflation at 3.3% and GDP growth falling to 2.1%. Oxford Economics modeled that oil averaging $140 per barrel for 2 months is sufficient to create an economic standstill in the United States. A $400,000 mortgage at 38% carries a monthly principal and interest payment of approximately $2,494. The viewer who was waiting for rates to come down before buying a home is now waiting in a different environment than they expected to wait in. Amazon added a 3.5% fuel and logistics surcharge for third-party sellers on April 17. UPS and FedEx have both imposed higher fuel surcharges since February. The next time a package costs more to ship, it will not say because of the Strait of Hormuz. It will just be more expensive. And you will not connect it unless you knew where to look. On April 18, 2026, the S&P 500 hit its third consecutive record high. Oil prices had dropped more than 12% in a single day on April 17 after Iran's foreign minister declared the Strait of Hormuz completely open to all commercial vessels. Markets surged. The financial headlines said the worst was over. BNP Paribas portfolio manager Sophie Huyn told CNBC something different. She said the market is not reflecting the economic reality of what we could be facing in the next 3 weeks. She warned that if oil tankers do not actually flow through the strait in meaningful volume by early May, the U.S. faces oil rationing. She noted that gas supply will take years, her word, to return to pre-war capacity. According to the IEA's April 2026 report, global oil demand is now projected to contract by 80,000 barrels per day on average across 2026. That is not a recovery figure. That is a demand destruction figure, meaning the global economy is consuming less oil not because the crisis resolved, but because prices forced consumption down. Markets have historically rebounded quickly following major military conflicts in the Middle East. Oxford Economics noted that this time could be more gradual because the supply disruption is 2 to 3 times larger than any previous geopolitical oil event in recorded history. The question the market is answering with a record high is the crisis over? The tanker data is answering a different question entirely. Iran declared the Strait of Hormuz completely open on April 17, and by Friday evening, Ships were moving through it at less than 20% of the volume that flowed before the war began. According to CNBC reporting from Keepler's commodity research director Matt Smith, ships that tried to exit the waterway on April 17 had clearly not been given approval to pass through and turned around. The U.S. blockade on Iranian ports remains in full force as of this recording. Iran's parliamentary speaker stated plainly that the strait will not remain open if the U.S. blockade continues. Experts quoted by Fortune describe Iran's control over the strait as now functioning almost like a nuclear deterrent, meaning Iran does not need to physically close the strait to control global oil prices. It only needs the world to believe it might close it. The threat alone prices the risk. Every barrel of oil, every tanker insurance policy, every mortgage rate calculation going forward is priced with that lever in the background. According to the Federal Reserve's 2024 survey of household economics and decision-making, 37% of Americans cannot cover a $400 emergency with cash. The first wave of this disruption is already adding roughly $65 per month to the average household budget. That number will increase when the fertilizer disruption reaches the grocery shelf in June. It will increase again if the strait remains effectively restricted and global demand destruction deepens. None of this requires panic. It does require adjustment. Practically, this means reviewing fixed versus variable expenses with a specific eye on anything fuel-dependent: utilities, groceries, shipping costs, transportation. It means revisiting any major financial decision that was built on assumptions about interest rates stabilizing or declining in 2026. It means not confusing a ceasefire headline with a resolved supply chain. And it means watching the tanker data, not the press release. The Strait of Hormuz is 21 miles wide. 1/5 of the world's oil once moved through it every day. That stopped in March 2026. The financial damage arrived first at your gas pump, then at your grocery receipt, and is still moving through your fertilizer supply, your mortgage rate, and the investment account you checked last week and decided was recovering. The second wave has not arrived yet. Drop your current age and the one household expense that has increased the most noticeably for you since February in the comments below, because the pattern across the audience tells a story that is worth knowing. If this video explains something that the news did not, share it with someone who is also feeling the price increases without understanding why. And subscribe if you want to follow this story as it develops. Stay logical.